Joining us right now to talk about what to expect is Barton Crockett, Rosenblatt Securities senior analyst. Barton, there's been a lot of nervous trading activity as we get closer to the earnings season for some of these stocks. You think, though, that there are some real buying opportunities. You want to lay that out?
Yes. Look, I think you've got in the kind of consumer internet group had front and center in earnings this week, some companies that have an accelerating top line with an expanding margin, with just great positioning. And I think you'd like to own these companies. I realize there's a lot of nervousness about the macroeconomic position, but I think these are companies that you'd want to own, whatever the macro, and these type of jittery situations are, instances when you want to look to accumulate. So companies in this camp, I think, include Pinterest. I think Amazon is well positioned for, revenue trajectory, margin expansion, along with Meta and Alphabet. Those would be the four companies that I'd be looking to accumulate heading into this.
How much of this is a situation where those companies got the message loud and clear? I'm thinking of Meta in particular about the spend that they were doing to that point. So they really controlled their expenses, cut back a lot of the spending that had been anticipated. But you've seen strong stuff like advertising really go up for some of Meta's properties too.
Yeah, I mean, it is true that many of these companies got religion when times are tougher, and that positions them really excellently when the top line improves. And Meta is really a great example of that. What they've done on the cost structure is really unparalleled. And what they're doing in the top line, they'll be accelerating in their guidance to a range of 15 to 24% year-to-year growth in this quarter upcoming, which is, for a company this size, is amazing. But Pinterest at a smaller level is doing something similar, pivoting to an e-commerce focus that's actually positive for user engagement, great for revenues, and an Amazon partnership that's poised to really contribute. So that's a company that's going to be pivoting from mid-single to high single-digit growth to an aspiration of close to 20% plus over the longer term, and we'll be inflecting towards that, we think, over the next couple of quarters.
Yeah, but all those names don't look that unnerved. I mean, Meta up 156% for the year to date.
Yeah, when I think about jitters, I just think about the trading action over the quarter, so over the third quarter and so far here in the fourth quarter. And, what you've seen is, Alphabet's traded nicely, so has Meta. But some of the other stocks like Pinterest are down a little bit with the market, and we think that they can do better.
For some of the big names, let's say Amazon in particular, you don't worry about any of the regulatory oversight and the real scrutiny that's being put on these companies right now?
Well, it's amazing what's happening with the U.S. government and antitrust. I mean, filing suits, losing suits at a rate that really is kind of unprecedented in the history of the DOJ. So, I think that their legal action is less worrisome really than ever before in terms of their success rate. The cases themselves, I think, are certainly debatable in some instances, particularly with Amazon. So I think a couple of things will happen. One is they could succeed. There could be breakups. That's probably equity positive.
Wait, back up one second. Equity positive if they were forced to break up Amazon? Yes.
I mean, I think that you've got some businesses that, if separated, the market would love to own. And and I think the multiple you could get for web services, the multiple you could get for what they're doing with e-commerce and their advantaged position there, and what's happening with them on the advertising front, those are businesses that investors, we think, would like to own. So
even if the company loses, you think shareholders win?
I think that's the base case. Yeah, is that a breakup is good for equity value. So it's
but that's not a base case. But I mean, that's a sort of big speculation. No,
that is our base case when we look at this litigation, is that the stocks are not going to be penalized, would probably benefit in a breakup. I don't believe that in this case that in Amazon that the Justice Department's going to prevail. I think Amazon's got a strong case. I think the retail market is very competitive. I think it's very hard for them to argue that Amazon doesn't compete with Walmart, doesn't compete with Target, and they have to do that to really argue that they have monopoly power, and I think it's going to be difficult.
If you think that these companies, that Amazon would actually do better if it were to split up for the shareholders, do you think that puts pressure on the company to do that eventually, or do they not have to do it because Jeff Bezos is going to control too much and it's not what he or other top managers would want, including Andy Jassy.
Well, look, I think that if we're wrong, and if Amazon's fundamentals, were challenged, like we're seeing at Disney, then they are, susceptible to a breakup. But I don't think that that's what's happening right now. That's really a completely different situation.
Barton, what would be something that would potentially concern you on any of these companies when you're listening on the earnings call?
Well, I think that obviously the worry point right now is the macro backdrop. And and I think part of the skittishness has been, what's really happening with the economy. I think, everything that we're seeing is, the economy is okay, and that should be a great backdrop for digital ad leaders that are taking share in the ad market. But interest rates, they start to bite, things start to weaken. It's going to be a more difficult period. That's why I'd like to buy quality companies with multiples that you can defend, with margins that are expanding. I think that is comfort, if you're facing potentially more difficult times in the future.